I am Hasik Thanki and the founder of Intro to Individual Life Underwriting. For those of you who are joining first time, today we are going to touch base some of the key aspects of what we call complex financial underwriting. Depending upon the typical day you may be having, you may be underwriting, let's say, 5 to 20 million face amount of every trial app that you review on a given day, maybe 5 to 10 cases, or you may be reviewing, let's say, in another situation where you are dealing with 200 to 300 pending cases in your in-trade, and you are looking at every day about, I would say, 30 to 40 cases, each one ranging from 500k to 1 million typical face amount. So at the end of the day, add up those face amounts of the trial apps or the formal applications that you end up reviewing, whether you are doing initial workup, whether you are doing a review of anything came in like a new info or a final action, either you approve or you decline. When you add up on your typical day, the face amount of the total, look at the final number that it comes down to, it boils down to. So that's the financial exposure you are taking, you are underwriting, you are reviewing on any given day. So be proud of what you are doing in life underwriting. So with that, today let's make an attempt to touch base some of the key aspects of complex financial underwriting. And as I have stated before, this is meant for those who are joining the life insurance underwriting career or profession, and keeping them in mind, just wanted to help them out. And let me start with a key man coverage. In your career, on a typical day, you may see that there is a life insurance application where you will see that coverage is being applied for, and that is a key man coverage. So what happens when a key man applies? The entity or the business or the company wants to make sure that, God forbid, something happens and if he or she is no more the key man, then what? So to protect that, they are interested in buying the key man coverage. Industry-wide, many companies would follow their own practice, their own specifics, but as a general rule of thumb, look at the annual compensation of that officer or the key man, and as a general rule, 5 to 10 times of the annual compensation, that would include bonus, other benefits, perks, and 5 to 10 times the coverage is considered on an average the reasonable and the right amount of coverage, subject to your company specifics. So that's when we talk about the key man. And if it goes over that, then you need more documentation, more details to make sure that how it justifies, if so, and does it make sense. Generally, the senior officers from a large corporations are the insurers that you would see. In a small, mid-size companies, partnership firms, if there are multiple key employees, then make sure that they all are applying for the equitable amount of coverage. Those are the things that you want to pay attention to. Are they nearing the retirement age? Those are the aspects that you may want to grasp and understand to justify the overall profile and the face amount or the financial justification. Another situation could be where you may have on the life app what we call a buy-sell. Buy-sell is like a family situation where In the agreements, they spelled out the business valuations. These are the things you just can't understand or grasp with such training tools. You have to have one-on-one, you have to look at and review the documents, more cases to fill for that. But generally what happens, the business pays for the insured's heirs. Let me go back and say that when the business valuation is out there in the buy-sell agreement, the benefits are paid to the business. Okay, so the benefits of the policy then goes to the business, and then business then pays to the insured's legal heirs. And what happens, the buyer is agreed upon in the agreement. The buyer then buys at the agreed upon price to avoid any surprise and forced sale, things like that. So something you may want to make a note of that. Another situation or specifics that you may confront on a given day, that we call cross purchase. So in cross purchase, what happens? Each stockholder will purchase the life insurance on the life of the other stockholders. The purchasing stockholder owns the policies and is the beneficiary. So that's how the cross purchase agreement goes. As far as next to that comes the entity agreement, which goes like that, with the main difference is that the business or the corporation buys a contract on each stockholder. So that's the main difference. Now let's take a pause and talk about a bankruptcy. There are going to be times when you will see on the life applications about insured going through the bankruptcy, not yet discharged, and or has become a history. The bankruptcy has been fully taken care, fully discharged, and it has become the history. Nothing pending. Depending upon your company specifics, and I'm not going to go into the details of chapter 7 or chapter 11 or chapter 13, that you will follow your referral underwriter whom you seek help for a second signature. But as a general rule, and because every company they follow their own specifics, one company may prefer to wait and watch for 6 months. Another company may prefer to wait and watch for up to even 2 years. And what is the history of the insured, financially speaking? Going back last 5 years, 10 years, or what do you see moving forward in next 2 years, 5 years, 10 years? So look at the big financial picture, the big financial profile. And as we discussed in the previous session, what are the documents you have? What is the age? What is the face amount? Correlate those details and follow your company specifics while dealing with bankruptcy. I'll leave it there as it relates to bankruptcy. Then you may have another situation, what we call in insurance profession is a creditor insurance. So long story short, more or less it coincides with the key man or the key person coverage. That is how it works. But generally speaking, the full amount of loan, although that is what we always see in our everyday scenario, but that is something that is not justified. So some companies would cover up to 75%, some companies would cover maybe more than that, some companies may cover the full amount based on your company specifics. So that is what you need to learn and you need to follow. There is another scenario that I would like to share with you that we call deferred compensation. So in deferred compensation, there are a couple of ways it can be done. One could be like a salary continuation. It is just like a personal insurance. So it is, bottom line, it's a deferred compensation. The salary continuation is a tool and it works like a personal insurance. And to that, there is another way or another category that is called split dollar. Split dollar is primarily where the employer and the employee, they both work together and they try to save. They both have the advantage of tax savings, and they both have the mutual interest. So again, that is a part of what we call the deferred compensation package. And what happens that they both are ready and willing to work together and come up with a policy that they can get the benefit of. Let me say that as far as the financial underwritings are concerned, there are multiple scenarios, but because we are at intro level, I don't want to get into more details. But last but not least, the take-home message I would say is this, that as you are starting your career, so one-on-one, listen to your referral underwriter. We have got huge experienced chief underwriters out there in the industry, so take advantage of their expertise and experience. And last but not least, I would conclude by saying that as you have just joined the life insurance underwriting career, start working towards earning your CLU, Chartered Life Underwriter designation. It will help you out because it will spell out from intro to intermediate to advanced level all these complicated cases and scenarios that can help you better grasp the complex financial underwriting. With that, take care and we'll see you again.